We appreciate everybody being here. The economy is improving. Economic data is promising. Treasury numbers are moving in the right direction. The tax reform law is being implemented. Overall, the economy is, as I say, moving in the right direction. However, we continue to see that lending and borrowing remain flat for small businesses. This becomes more acute as you get down to the smaller firms across the nation. We continue to hear that financing projects for growth and expansion, which leads to job creation, are challenging. One of the top priorities for this committee is to study how we can create an environment for small businesses to flourish. I can't say it enough, when small businesses grow, so does our economy. To address the gap that small businesses face when financing their projects, the SBA offers the 7A loan program for small businesses that have a plan in place for growth but lack the qualifications for conventional lending, such as collateral. Recent growth in the program has led to a closer look at the SBA's oversight tools. As a result of multiple hearings, meetings, and briefings, I, along with the ranking member and our Senate counterparts, introduced H.R. 4743, the Small Business 7A Lending Oversight Reform Act of 2018. This bicameral and bipartisan legislation aims to ensure the integrity of the program while bringing stability to small businesses that truly require the services of the SBA. Specifically, H.R. 4743 strengthens the Office of Credit Risk Management, which oversees lenders at the SBA. It does so by reinforcing the office's oversight authority, increasing enforcement options, enhancing the lender review process, and cementing the SBA's use of the Lender Oversight Committee, which plays a major role in significant enforcement actions. Beyond strengthening the oversight activities of the SBA, this bill will also require a more transparent budget process to ensure the SBA is allocating oversight dollars properly. This committee often discusses the importance of credit elsewhere test. This is not an understatement. This test acts as a gateway into a federal government guarantee. Simply put, the 7A loan program cannot be used by small businesses that can receive traditional bank lending. This legislation bolsters the test by updating and clarifying the factors often used in that test. It's important to note, because of the fees associated with the program that are paid by participants, the 7A loan program runs on a zero cost to American taxpayers. To ensure that this remains the case and to ensure the program remains an option for credit-worthy small businesses that justly need it, strong oversight is mandatory. I believe we are heading in the right direction. We have already begun to hear from 7A loan participants, and I want to share a quote from a letter of support. I would ask unanimous consent to enter the letter into the record, and this is the letter here from Huntington, and without objection, so ordered. It is, as I mentioned, from Huntington Bank, a storied institution from my home state of Ohio. And to quote a couple of small parts, "This legislation is focused on the long-term success and sustainability of the SBA programs that serve to grow and protect small businesses," unquote. On the provisions to improve the credit elsewhere test, Huntington says that the changes will, quote, "protect the program's integrity," unquote. Do we have more work to do on this topic? Absolutely. I see this as a starting point, not the end point. For the nation's mom-and-pop shops, to those operating a franchise, to those creating the next great American product or service, we are just beginning. This hearing will provide committee members the opportunity to hear from participants in the SBA, or excuse me, in the 7A loan program about how the proposed changes will ensure real growth while providing certainty to small businesses. We appreciate the witnesses for being here this morning. We look forward to your testimony, and I would now like to yield to the ranking member for her opening remarks.
Thank you, Mr. Chairman. All of us are acutely aware of the vital role access to capital has in the success of our nation's 29 million small businesses. Without it, they cannot stock their shelves, pay their employees, or upgrade equipment. Capital is the key to unlocking opportunities to grow and create new jobs in the local economy. A vital pathway to accessing that capital is through the 7A loan program, SBA's flagship lending product. At the beginning of this Congress, our committee held a series of hearings to take the temperature of the 7A program by looking at how it's being used and administered. The good news is it is as successful as ever. In 2017, the program made 62,400 loans, totaling $25.4 billion, an all-time high. At the same time, defaults are at historic lows. Conventional lending to small businesses has yet to return to its pre-recession peak, however, making the 7A program all the more important to driving economic growth. The 7A program is not without shortcomings. Both lenders and the agency have said oversight could be improved. The oversight toolbox made more robust and transparency increased with legislative action. This committee heard you and set out to address your concerns. The Small Business 7A Lender Oversight Reform Act of 2018 addresses a number of issues and makes long overdue reforms to the program. The Act codifies the Office of Credit Risk Management and Lender Oversight Committee and outlines the key employees and duties of each. It also requires the office to internally submit a budget to ensure there is justification of the fees, salaries, and expenses used to carry out oversight functions. These reforms ensure the oversight process will have transparency and uniformity for both lenders and the SBA. We also heard that the credit elsewhere test, a bedrock of the program, was not clear enough and lacked an SBA verification component. This bill better articulates the characteristic of the credit elsewhere test and bolsters verification of how it is fulfilled. Finally, we all remember 2015 when the program ran out of authority to lend before the end of the year. This created an artificial run on the lenders to get loans approved, unfairly harmed small businesses that needed credit, and ultimately required congressional intervention. Today's bill incorporates provisions from legislation I introduced earlier this year, empowering the SBA administrator to request additional lending capacity from Congress to meet unexpected demand late in a fiscal year. With improvements offered by the chairman, this streamlined process strikes a common-sense balance between congressional oversight and ensuring SBA can keep making loans to deserving businesses that cannot get credit elsewhere. I want to thank Chairman Chabot and his staff for working in such a collaborative manner on this legislation. I also want to thank Senator Risch and Shaheen and their staff for making this process both bipartisan and bicameral. Through debate and compromise, we arrived with a legislative product we can all be proud of. Administrator McNann and her team and the trade organizations testifying today were also vital in crafting this bill, and we greatly appreciate your input. With that, let me thank our witnesses for being here today to continue this discussion. I look forward to hearing today's testimony. I yield back. Thank you, Mr. Chairman.
Thank you very much. Gentlelady yields back, and I would like to thank the ranking member for her leadership and her cooperation and the bipartisanship that she and her staff showed with ours in crafting this as well. We really do try to work in a bipartisan manner on this committee, and we certainly showed that in this case. If committee members have opening statements prepared, I ask that they be submitted for the record. And I'd like to take just a moment to explain our timing system and the lights and that sort of thing. Rules are pretty simple. You get 5 minutes to testify, and we'll have 5 minutes each to ask questions. There's a lighting system to assist you. The green light will be on for 4 minutes, and the yellow light will be on for a minute to let you know it's about time to wrap up, and then the red light will come on, and we'd ask you to stay within that those parameters, if at all possible. And I'd now like to introduce our distinguished panel here this morning. Our first witness is Ms. Cindy Blankenship. Welcome back to the committee. Ms. Blankenship has been a frequent visitor and guest here and speaker, and has done really a fine job over the years. And she's the vice chairman and chief operating officer of the Bank of the West in Grapevine, Texas, which opened in 1986 under her leadership. Ms. Blankenship has spent years as a leader in community banking in Texas, Texas and throughout the country. She's also been a past chair of the Independent Community Bankers of America and a member of the FDIC's Advisory Committee on Community Banking. Ms. Blankenship is testifying today on behalf of the Independent Community Bankers of America, and we welcome you back. And our next witness will be Ms. Patricia Husick. Ms. Husick is the President and Chief Executive Officer of the Centric Bank in Harrisburg, Pennsylvania, which she established. Prior to her time founding Centric, Ms. Husick was an executive at a number of Pennsylvania financial institutions and is a past chair of the Pennsylvania Bankers Association. With nearly 3 decades of banking experience, Ms. Husick has been recognized on multiple occasions as one of the 25 women to watch in banking. Ms. Husick is testifying today on behalf of the American Bankers Association, and again, we welcome you today. And I would now like to yield to the ranking member for the introduction of our other 2 witnesses this morning.
Thank you, Mr. Chairman. With more than 20 years of experience and increasing responsibility in marketing, strategic planning, management, and lending, Sonia McDonald has spent the majority of her career in the credit union industry. As the EVP Chief Lending Officer at RBF CU, Sonia is currently responsible for a $6 billion portfolio, including $22 million in SBA loans. Ms. McDonald holds a bachelor's degree of journalism from the University of Texas at Austin. Welcome and thank you for being here. Tony Wilkinson has served as President and Chief Executive Officer of the National Association of Government Guarantee Lenders for more than 25 years. He is responsible for overseeing the association's government relations strategy and often offers expert testimony before Congress. He works closely with SBA and the small business committees to ensure the continued stability and availability of the SBA 7A business loan program to the nation's small businesses. Welcome and thank you for being here.
Thank you very much, and we'll now hear from Ms. Blankenship, and you're recognized for 5 minutes. Thank you.
Chairman Shabbat, Ranking Member Velasquez, and members of the subcommittee. Cynthia Blankenship, Vice Chairman and Corporate President of Bank of the West in Grapevine, Texas. It's a $450 million community bank with 105 employees in the Dallas-Fort Worth suburban area. I'm also a former chairman of the Independent Community Bankers of America, and I'm pleased to testify today on behalf of more than 5,700 community banks represented by a CBA. A robust 7A program with broad community bank participation will help small businesses thrive and create jobs. We are grateful for this committee's strong support of the 7A program. Bank of the West is a 30-year partner with the Small Business Administration and a leading SBA lender in the Dallas-Fort Worth district. We currently hold and service nearly $100 million in high-quality SBA loans with a minimal loss ratio. Historically, Bank of the West's 7A loans have created thousands of jobs in the communities we serve and help sustain and strengthen our local economy. Bank of the West uses the 7A program to supplement our lending and credit services by reaching a broader range of borrowers who would not qualify for conventional loans. To preserve the long-term viability of the 7A program, ICBA supports targeted reforms, such as those contained in the Small Business 7A Lending Oversight Reform Act, H.R. 4743, to ensure its integrity and continued safety and soundness. H.R. 4743 would codify the SBA Office of Credit Risk Management, which supervises and oversees all SBA lenders, and the Lender Oversight Committee, which reviews the office's enforcement recommendations. The bill would provide guidelines for lender reviews, codify lender appeal rights, and create greater transparency in the office's budget. These provisions strengthen the integrity of all SBA lending programs, and all responsible lenders should support them. The 7A program is only available to small business who would not otherwise qualify for a conventional loan. To safeguard the program from abuse, H.R. 4743 would codify the SBA's Credit Elsewhere test, which requires lenders to fully substantiate and document the reasons a given applicant cannot be served with conventional credit. Stable funding of the SBA, the 7A program, is critical to the thousands of borrowers who rely on it. It is, as is well known to this committee, program funding came to an abrupt halt in the summer of 2015 when it reached its authorization cap well before the end of the fiscal year. Congress was forced to pass an emergency increase to the authorization cap to restart the program. ICBA greatly appreciates the support and responsiveness of this committee in passing the emergency increase. Thankfully, the hiatus was short-lived. A longer program shutdown would have cut off the thousands of small businesses that rely on this program for payrolls, investment, and expansion. While the 7A program is fully funded by user fees and no taxpayer dollars are appropriated, a program authorization level must be approved by Congress each year, and once that level is reached, no more loans can be approved. H.R. 4743 would give the administrator authority to raise the cap by up to 15% one time each fiscal year with the approval of the House and Senate authorizing and appropriating committees. I have focused my remarks today on the 7A program. However, taking a broader perspective, I urge this committee to support regulatory relief that would strengthen community banks and enable more small business lending in SBA programs and in conventional markets. We are grateful to the Financial Services Committee for its passage of numerous regulatory relief bills in this Congress and past Congresses. These bills were the groundwork for the Senate Banking Committee's passage of S. 2155 in December on a strong bipartisan vote. S. 2155 contains robust regulatory relief for community banks, which will create more small business credit, economic growth, and jobs. We urge the House to quickly pass S. 2155 when it is sent over from the Senate in the coming weeks. We must not miss this long-awaited opportunity for community bank relief. Thank you again for convening this hearing. I'm happy to answer any questions you may have.
Thank you very much. Ms. Huzik, you're recognized for 5 minutes.
Thank you. Chairman Shabbat, Ranking Member Velasquez, and members of the committee, I'm Patricia Husick, President and CEO of Centric Bank, a community bank headquartered in Harrisburg, PA. I appreciate the opportunity to present the views of ABA on legislation that would improve the availability of SBA 7A loans and oversight of the program. ABA applauds your leadership, Mr. Chairman and Ranking Member Velasquez, in introducing H.R. 4743 and working with your Senate counterparts. The SBA 7A loan program is very important to small businesses as it helps fill a critical gap, particularly for early-stage businesses that need access to longer-term loans. This long overdue bill will strengthen the SBA's oversight office and provide flexibility to the administrator to increase the program's maximum lending authority in the event it would be reached. At Centric Bank, the 7A program has helped hundreds of entrepreneurs during the past 10 years start their own business, purchase an existing one, or expand a current business. At Centric Bank, we view SBA lending as a way to get a customer to yes in a safe and sound manner. Without this program, many entrepreneurs would never realize their dream. For example, over 5 years ago, a young customer had a dream of owning his own restaurant in Harrisburg. When he finally found a business to purchase, he was unable to obtain a traditional bank loan. Through the 7A program, we were able to help this owner acquire the building and business with a 10% down payment and appropriate repayment terms. His business is profitable, and just 9 months ago, we financed a second restaurant for him using the 7A program. The program enabled this entrepreneur to realize his dreams, and now he is the owner of 2 profitable and successful restaurants, employing more than 60 people. We also assisted a U.S. Army veteran who wanted to open a gun range with education and training for the public. They also had the foresight to open their facility to police municipalities to provide access for the officers while they were off duty. The customer was unable to obtain financing through a traditional bank loan. With a longer-term loan provided through the 7A program, the business owners obtained the financing they needed, and they were able to open their facility. They have hired 20 people, the majority of whom are veterans. Another customer of Centric Bank was looking to expand his existing minority-owned construction company from Philadelphia into the New Jersey markets. Centric Bank closed a $675,000 7A loan to buy the commercial building, provide working capital for expansion, and hire new employees. Without the SBA guarantee, we would not have been able to provide the funding due to an overall collateral shortfall. This loan has provided our customer with a foundation for sustained growth. It is essential that small businesses that qualify for the 7A loan program are able to utilize the program to obtain access to the necessary capital to build and grow their businesses. In past years, this has been a challenge as the program has hit its funding limits. H.R. 4743 would grant the authority to the administrator to increase the amount for general business loans up to 115% of the fiscal year's limit. This important measure helps ensure that small businesses will not be affected by temporary shutdowns in the program, leaving them unable to meet payroll, purchase inventory, or secure equipment and supplies. Importantly, this bill also takes steps to improve the oversight of the program to prevent fraud and increase efficiency. Clear responsibilities for the Office of Credit Risk Management, including risk analysis, provided timely findings to lenders, and establishing a lender oversight committee should ensure the appropriate level of accountability while maintaining checks and balances. H.R. 4743 also helps to ensure capital goes to small businesses that face financing obstacles by clarifying the factors considered in the credit elsewhere test. The 7A program is an example of how bank lending facilitates economic growth. This program should be vigorously supported in the future, and H.R. 4743 is an important measure to ensure the continued success of this program. In my written statement, I outlined several suggestions that would improve the servicing aspects of 7A program and would hope the committees would consider these in your deliberations. And thank you. I'd be happy to answer any questions.
Thank you very much. Ms. McDonald, you're recognized for 5 minutes.
Thank you. Chairman Shabbat, Ranking Member Velasquez, and members of the committee, thank you for the invitation to appear before you this morning. My name is Sonia McDonald, and I am testifying today on behalf of NAFCU. I am the Executive Vice President and Chief Lending Officer at Randolph Brooks Federal Credit Union. In this role, I'm responsible for a $6.6 billion portfolio that encompasses consumer, mortgage, and commercial lending. I appreciate the opportunity to share with you our thoughts on strengthening the Small Business Administration's 7A loan program. RBFCU became an SBA preferred and express lender in September of 2005. We are delegated with SBA authority and are able to offer all of their products. In both 2016 and 2017, we were the #1 SBA lending credit union in our 55-county district. SBA products allow us to leverage our lending dollars, mitigate the risk associated with the loans, and extend more credit to our community's small businesses. Our current portfolio has 210 active SBA loans with a balance of approximately $23 million. There are many stories of small business owners looking for that loan that will allow them to either start or grow their business. While other institutions may have scaled back their small dollar business lending, credit unions have been willing to fill that void. At RBFCU, we are pleased that we have been able to step up to help meet the demand. SBA 7A loans make it easier for credit unions because the government-guaranteed portion of these loans does not count towards the arbitrary credit union member business lending cap. In San Antonio, we have a great bagel shop, the Bagel Factory, owned by an Air Force veteran and his wife. They went to 20 different places and were denied before coming to Randolph Brooks for an SBA loan. That business is now thriving as it enters its 8th year. This is an example of the kind of business that SBA 7A loans are here to help. Last year, NAFCU renewed a memorandum of understanding with SBA to help address the challenge of getting more credit unions involved with the SBA. The MOU formalized a joint partnership that aims to increase the availability of small dollar loans by providing more outlets for entrepreneurs to access SBA products in their neighborhoods. And it makes the small dollar loans more accessible to underserved communities, including women and minorities. We appreciate the work SBA has done to improve their processes. We also support your legislative efforts in H.R. 4743 the Small Business 7A Lending Oversight Reform Act of 2018. This legislation will help credit unions by bringing more clarity to SBA's 7A loan program by outlining more specifics in statute. We are particularly pleased to see the credit elsewhere test better defined in the bill as compared to what is included in the standard operating procedures. This will help clear up ambiguity for lenders. One of the most important parts of the bill is the administrator's authority to increase the budget amount to 115% of the limit. This would be beneficial to both borrowers and lenders versus the hard cap that currently exists, and helps ensure that lenders and small businesses will not face a situation where the ability to use the 7A program comes into doubt due to the popularity of the program. One area where we think the legislation could be improved would be to have better definitions for penalties. Adding clarity that requires the director to distinguish between minor compliance errors and willful or negligent violations would be helpful. Overall, we believe this is a solid legislative package and would urge the committee to support and advance this legislation in a timely fashion. In conclusion, small businesses are the driving force of our economy and the key to its success. The ability for them to have access to capital is vital for job creation. While SBA's 7A program provides opportunities to established and struggling businesses, there continue to be ways the program can improve. The SBA has taken some steps in the last year to improve the program. Enacting the Small Business 7A Lending Oversight Reform Act is another step that will help. We urge you to support this legislation. We thank you for your time and the opportunity to testify before you today on this important issue. I would welcome any questions you may have.
Thank you very much. Mr. Wilkinson, you're recognized for 5 minutes.
Thank you, Mr. Chairman, Ranking Member Velasquez, and members of the committee. My name is Tony Wilkinson, and I'm here on behalf of the National Association of Government Guaranteed Lenders. NAGLE is a national trade association representing banks, credit unions, non-depository lenders, and other entities that participate in the Small Business Administration's 7A loan guarantee program. And NAGLE's members are responsible for approximately 80% of all the SBA 7A loans made annually. This committee and its colleagues on the Senate Committee on Small Business and Entrepreneurship have been looking into the performance of the SBA 7A loan program and SBA's role in oversight of the program for about the last 3 years. There has been great care taken by this committee to approach this issue with diligence, and as the CEO of the SBA 7A's Industries Trade Association for the last 30 years, I can tell you honestly that your careful approach to this matter is a rarity in the history of this program, and it is incredibly appreciated. Your staff, particularly Rob Yaver for the majority and Justin Pelletier for the minority, and since they're in the audience, I'll give a shout out to Renee Bender on the majority and Kevin Wheeler on the majority over in the Senate. They have worked diligently to understand the very technical issues of the 7A program. We also very much appreciate the committee's announced intention to continue to work with industry and the agency to perfect H.R. 4743 going into the markup process. The lending industry that NAGLE represents is grateful for this committee and its staff's longstanding commitment and dedication to engaging the many stakeholders throughout the process, and we look forward to working with you and with SBA to assure that the final legislation provides appropriate direction for SBA's lender oversight efforts. I'm pleased to testify today to discuss NAGLE's support for H.R. 4743, the Small Business 7A Lending Oversight Reform Act of 2018, which will strengthen SBA's Office of Credit Risk Management and how it performs its role to oversee the 7A program. One of the most important provisions to the lending community included in H.R. 4743 includes granting flexibility authority to the SBA administrator to increase the 7A program's authorization cap by 15% if the pace of lending is set to exceed that fiscal year's given cap. NAGLE first presented this flexibility language to the Office of Management and Budget and to Congress in the wake of the fiscal year 2015 7A lending shutdown, drawing on the same language and precedent set by the House and Senate Appropriations Committees in their treatment of various USDA loan programs. Since then, NAGLE has enjoyed the partisanship of Senator Risch, Coons, and Shaheen, to name a few last Congress, who introduced a bill in the Senate to establish cap flexibility, and in this Congress, Ranking Member Velasquez championed a bill in the House to move this proposal forward. And as you know, OMB included this language in the last 3 presidential budget proposals, so SBA has been a champion for this proposal as well. In both fiscal year 2014 and in 2015, the SBA 7A program saw demand from small business borrowers reach the program's authorization cap before the end of the fiscal year. And in fiscal year 2015, the program shut down for several days. Some of you on this committee helped see unusual measures of emergency supplemental language pass Congress and receive the President's signature to ensure the 7A program remained available to the country's small businesses, and industry owes you a great deal of gratitude. But those were rare instances of congressional intervention, and unfortunately, these threats of shutdown destabilize the program and alter lender behavior. The issue largely stems from the great difficulty in anticipating the exact number of borrowers who will be applying for SBA 7A loans 18 months in advance as we go through the budget process. While this flexibility language should never supplant the role of Congress in setting authorization caps, and still requires approval from this committee and its colleagues in the Senate and in the Appropriations Committees, it serves as a common-sense safeguard against last-minute panic. Thank you to this committee for embracing and now championing this concept. H.R. 4743 also updates the credit elsewhere provision currently in statute, a clarification lenders have long asked for and which is critically important to the program. The cornerstone principle of the 7A program is that it complements but does not compete with conventional small business lending. The non-competitive status of the program is assured by the fact that before any 7A loan guarantee can be approved, the participating lender must certify that the loan could not be made without the SBA guarantee. NAGLE believes the proposed legislation will strengthen compliance with the credit elsewhere requirement by clarifying the types of situations which cause the SBA guarantee to be required and provide further assurance that 7A loans continue to fill the existing small business credit gap. Finally, I would like to applaud the chairman and ranking member for the provision of the bill which improves the oversight review process for lenders. NAGLE has long called for full-time employees of SBA to lead each team of reviewers that conducts the oversight reviews of the program's participating lenders. When there is a full-time employee present and supervising each review, it ensures that there is a deep foundation and understanding of the incredibly complicated policies that are specific to SBA. There's a whole host of other provisions in this bill that I would be happy to discuss, and with that, I will conclude my remarks.
Thank you very much. And I'll recognize myself for 5 minutes to begin the questions, and I'll open with a general question. I'm just going to kind of go down the line here. On the small business lending environment in our country, we hear that small businesses and their optimism is on the rise. Is this increase in optimism being matched by a demand for small business loans that you're seeing at your particular institution? And if you could just give us a general climate, and I've got some other questions, so if you could maybe take 15 to 30 seconds or so to answer, and I'll begin with you, Ms. Blankenship.
Well, I'm in the Dallas-Fort Worth Metroplex, and North Texas economy is thriving. So it has been very encouraging to see small businesses start to be encouraged by the economy and believe that they can now take the chance to gamble and leverage. We saw many businesses just sit on liquidity for years after the crisis. So we are seeing an uptick.
Good. Thank you very much. Ms. Huzik?
We are seeing a lot of increase of SBA lending and small business lending. As a point of reference, so Centric Bank, we're headquartered in the Harrisburg, PA area. We also loan in Lancaster County, where we have an office, as well as an office, and we loan throughout the suburban Philadelphia market, as well in the western part of New Jersey. For some statistics or number to support that, for example, last year our organization had about a 30% growth in our commercial lending, of which we're 85% focused on small business. Last year, we originated over $200 million in commercial lending, of which $38 million was SBA 7A loans to about 46 clients. Looking at 2017, we originated about $210 million in commercial loans. That SBA 7A number was in excess of $41 million, but to more borrowers, to approximately 77 borrowers.
Okay. Thank you very much. Ms. McDonald?
Just like Ms. Blankenship, I'm in Texas, and Texas has had a very strong economy. What we're seeing is more confidence.
Pull that mic a little bit closer there. Thank you.
What we're seeing is more confidence in the economy. We're seeing more applications from our small business members.
Okay, great. Thank you. Mr. Wilkinson?
Well, while I'm not a direct lender, our members are reporting robust growth. Our loan volume through the first couple of weeks of January, year to date, this fiscal year, we're up 18% nationwide in 7A lending. So
Okay.
good economy.
Good. Glad to hear that on all counts here. And Mr. Wilkinson, I'll go to the next question with you. This committee has emphasized the importance of the credit elsewhere test in the past. Can you provide a little detail on how this test works in practice? And do the changes in the bill that we're considering here today, will they further clarify and bolster this test to ensure that the correct small businesses are entering the program?
Be happy to. As has been mentioned here, the cornerstone tenet of the 7A program is that it does not compete with the commercial lending marketplace, that it complements it. The issue becomes how to provide better guidance to lenders to assure that the credit elsewhere test continues to be appropriately met for each and every loan. And part of the issue has been for our lenders is that the current definition has not been updated for decades. And I thought I would read to you what it currently says. It says, for purposes of this act, the term credit elsewhere means the availability of credit from non-federal sources on reasonable terms and conditions, taking into consideration the prevailing rates and terms in the community in or near where the concern transacts business. Well, in today's lending environment, geography really doesn't matter. And so there's a lot of language there that becomes confusing to our members and how to comply with that statute. So we believe the language that is in H.R. 4743 clears that up, defines what are acceptable items that need to be reviewed and would be required for the lender to document in their file.
Thank you very much. Ms. Husick, I've only got about a minute left. So as you know, this bill would require SBA to perform a portfolio risk analysis. And I want to make sure you don't think we're going too far there. I see Congress receiving this information is very important. However, from your perspective, we're not asking too much there, are we?
Absolutely not. When we take a look at, I think, I look at our own organization, when we take a look and evaluate the loans we book to our portfolio, with each of those certain industries, concentrations, we have a certain percentage of our capital that's allocated to that. From there on an annual basis and even more so on a quarterly basis, we do evaluate that, and I think that's a good business practice. Furthermore, it's a good risk management practice to do that.
Thank you very much. And my time's expired, and the ranking member is recognized for 5 minutes.
Thank you. Chairman. Mr. Wilkinson, all of you mentioned that this bill includes flexibility language for the administrator to request an increase in the authorization cap of the program to meet unexpected demand. There seems to be some confusion about how this will work in practice. So my question to you is, can you elaborate on this authority? How can it be used?
Be happy to. First, this authority is actually mirrored by the same authority appropriators have given to the Department of Agriculture's USDA loan guarantee programs in recognition that demand on any given day, week, or month can often exceed expectations, and that lending is cyclical. The intention as set out in this language is that the authority can be used only once per year. So presumably the agency would want to use this authority at the end of or towards the end of a fiscal year to prevent programmatic shutdown if the authorization cap was going to be insufficient, as that was the case in 2015.
So not at the end of a short-term CR, correct?
Correct. So at a CR, it really becomes a function of do we have what's called anomaly language in the CR that allows SBA to spend at whatever the pace of demand might be.
And can you please explain how the anomaly process can work?
Be happy to. So what happens under a CR is the Office of Management and Budget takes the number of days that are provided for in the CR and divides that into the authorization cap for the year. So we get X amount of money to lend during that period of time. With an anomaly, that calculation is not necessary. We're allowed to spend up to the authorization cap at whatever pace. And just so folks understand, we hit that apportionment cap at the last CR. We actually had a program shutdown for a few hours. A lot of folks don't know that we did, but we had a program shutdown for a number of hours as the last CR ended and the current one started. There was a gap there for about 6 or 7 hours.
Thank you. Ms. McDonald, SBA Capital Access mission is to aid and assist America's small businesses, including underserved and vulnerable small businesses, to obtain the capital that they need. So does SBA encourage lenders to make loans to underserved markets, such as to firms majority owned by those who are socially and economically disadvantaged, and to new businesses?
Well, at Randolph Brooks Federal Credit Union, we have about 240 SBA loans to minorities, approximately 230 to women, and 167 to veterans. So this is a huge part of our SBA lending. That's what credit unions are here for. We are here to provide those small dollar business loans to folks who couldn't get it. The average SBA loan at Randolph Brooks is less than $90,000. And I would say more than half of our SBA loans are for less than $75,000.
In your meetings with SBA officials, if there's any discussion as to, what is it that you're doing to increase small business lending for underserved communities or underserved small businesses?
Well, at Randolph Brooks, we serve a lot of underserved areas. We call them community charter areas, and we look for opportunities to help folks. I'm thinking right now of a Mexican restaurant in the south side of San Antonio. So we have lots of opportunities to do that, and the SBA has gotten much better at working with us to make things easier.
Ms. Husick, thank you. Ms. Husick, you testified that increasing the time that a seller can remain on as an employee with the business will be beneficial. This is something I am also exploring as a way for the 7A program to help ESOP and co-op ownership transitions. Can you please elaborate on why extending this period is necessary and whether there are any additional safeguards that could be implemented to address concerns about a seller double-dipping after the sale of the business?
Absolutely. We've had certain situations where perhaps it's a first-time business owner, they are acquiring the business, and which would be helpful, and we're not looking for a long-term period of time, but maybe in certain situations, a 2-year period of time might be valuable. When any type of loan we're making, conventional or an SBA, we're always looking to set the borrower up for success. So maybe navigating some challenging times in a business, and they have not been through that before, maybe some also intricacies in with particular clients could be beneficial. I think in the end that new business owner has to have the ultimate ability to terminate that employment and to give them control, so there's no double dipping going on there.
The gentlelady's time has expired. The gentleman from Kansas, Mr. Marshall, Dr. Marshall, is recognized for 5 minutes.
Yeah, thank you, Chairman. My first question is going to be for Ms. Husick, and then I'm going to ask you other three the exact same questions. I'm going to give you a chance to prepare. And the second question is going to be how is the Tax Cuts and Jobs Act going over in your community? What has it done to unleash this economy? If you can give me some examples. But my first question for Ms. Husick, been part of a bank board for 15 years, and over I saw the great things that the small business loans did. Specifically, what has this bill done to improve that process? How is it going to help your customers?
Well, first and foremost, the SBA and specifically the 7A program is a great program, and it's an opportunity. If you can't do the loan conventionally, how do we get our client to a yes? And that's what we look to do. A small business is 85% of our lending. But when you take a look at some of the processes, we've had some clients that when a number of years ago, the SBA ran out of funds, and we were getting ready to settle. We were waiting for the SBA approval. We are a non-preferred lender, so that we submit our applications to the SBA and wait for the approval to come back. And we were sitting there with that particular client. We couldn't get them over the finish line. And, with that unnecessary or that wait that you could never give them at specific timeline, we've also had another client at that same time frame was looking for a loan. And it was to be able to support additional inventory connected with an additional contract, which again, these type of things would help that if that situation would
Does this bill
present
make it
itself.
more efficient? You think,
I think it will make it more efficient, but also that if the SBA runs out of funds, they would have the ability to have that additional 15% to be able to extend that.
Got it. Okay. Ms. Blankenship, how is the Tax Cuts and Jobs Act impacting Texas?
Well, I think very
I'm not sure if that mic's on.
Sorry. To answer your question, the tax cut has had a positive effect on the Texas economy. On our small businesses, I see a lot of encouragement, a lot of future planning. They seem to be willing to leverage those additional dollars saved by their tax savings, which in turn helps the community. So we're very excited to see that.
And you hope this 7A is just one more step to
And the
making
step.
those dreams come true, live this American dream.
Exactly.
Ms. McDonald, where are you from, remind me?
San Antonio.
San Antonio, another Texas gal. We're just
Another
loaded
great
with
Texas
Texas
town.
here. How's the tax cuts bill working down there?
It's going very well. We had a record year in lending last year, particularly towards the end of the year. You know, typically in November, December, lending slows down. We had record months. In fact, I got an email just right after Christmas that said we had over 1,800 loan applications in one day. And so that's pretty incredible, especially on a skeletal staff at Christmas time. But and from the small business perspective, we are seeing an increase in those applications. And in fact, we are hiring an additional business loan officer to keep up with the demand.
So maybe this law we're working on will dovetail right into those 1,500? Is that what you said?
1,800 loan applications.
in a
Now,
day.
these were for consumer loans.
Sorry. Okay. Mr. Wilkinson, how do your customers, your clients, been impacted by this tax cuts bill?
Well, I represent the lenders, so I'm not dealing directly with our small business customers. But as I mentioned, our loan volume is up 18% year to date, so something good is happening. But I did want to respond to your earlier question: how does this bill help small businesses? And it's more from a programmatic perspective. We want this program to be a program of integrity. It's working great right now. We want it to continue to work great. We are ahead of this curve. We want to make sure SBA's got the tools and resources to keep the lenders between the lines. So we're not responding to any kind of problem right now, but we're going to make sure that this program is here for the long haul for borrowers for many years to come.
Okay. Ms. Husick, you haven't had a chance to respond to my tax cuts question. I thought we'd get back to you. I think you've got a story to tell as well.
For the tax cuts, you know, we're exploring several different ways of where not only how do we help more small businesses. We have not finalized on any specifics of what we will do as an organization. At this point, our board is still finalizing that, but we see great opportunities within our marketplace. There's a lot of small business optimism and more interest in starting businesses and expanding, buying more capital outlays, those type of things.
Yeah, I think I would just close this. I finished up my town halls this week, going to every county. Over and over, the economy is improving, and people ask me why, and see if you agree with this. I think number one is we've cut back on regulations, and I think number two is the consumer confidence is incredible out there, and then lastly is this tax reform. Is there any other big picture out there that you think is added to the sudden, not necessarily sudden, but the great economy we're experiencing?
To your point, I believe all those things and those reasons encompass the reason why there is small business optimism, and as they are the job creators. As we're looking forward, as you mentioned, as far as some relief of regulatory burden, you know, as community bankers, we're looking for some of that relief as well, of the additional amount of regulation and burdensome that, you know, over the past 8 to 10 years, community banks have really been burdened with.
Thank you for your story. I went over. I apologize, Chairman.
That's okay. Gentleman's time's expired. Gentleman from Pennsylvania, Mr. Evans, who's a ranking member of the Subcommittee on Economic Growth, Tax, and Capital Access, is recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to start out, starting from Ms. McDonald and go down that particular direction, about what ways do you think that can improve this particular program? So I'll start with Ms. McDonald, then to her right.
Well, I think that this bill is a great start. Codifies the expectation. Talked about the credit elsewhere test. From a credit union perspective, and we've talked about this before, but increasing the member business cap for credit unions would help. There's a lot of credit unions who are not in or do not participate in SBA lending because it does take a lot to get a program started. You would have to hire somebody, and then if you're wildly successful, then you have to cut back, which doesn't do anything for member service.
several other ways that the SBA 7A program can be enhanced. Currently, the law does not allow for any type of consolidation or refinancing with the current lender, so that if that business owner would like to do any of those things, they cannot do it. So, for example, if they've been with our organization for several years, they need to go to another financial institution. And I think that's very challenging for that business owner, because here is someone they have a relationship with, they know their business, they're forced to go elsewhere in order to do any of those items. An opportunity to looking at this particular bill here is that if there's an opportunity to carve out for the portfolio lenders and suggesting of banks with assets under $1 billion. So, for example, with this particular piece, that if prior to this, if you are in excess of our legal lending for a bank is 15% of our capital is what we can lend. With the SBA guarantee, you could back that out. That is no longer the case. So for those of us who are portfolio lenders and we want to make loans in our communities, that can be prohibitive to us. Also, too, we talked briefly about having the seller remain on for an extended period of time. In situations we've seen was up to a 2-year period of time to help maybe navigate through the waters of being a first-time business owner. But a new component with this is that a key employee who is not an owner can be required to guarantee the loan. And the SBA can come back and require that. They're going to have all the challenges or the downside of guaranteeing a loan without having the benefits of an ownership. And I don't know many individuals who's an employee who's not an owner that'd be willing to sign to guarantee that. So those are some of the items I would recommend.
I would just echo their comments, but I would like to expand on the inability to refinance your own credit. We take the risk on these small businesses when they come in, and we use this SBA 7A program because that's what it was designed for, those small businesses that can't get conventional credit. But our bank, our small community banks, are taking that risk. And so when the business gets up and successful, if you could look at maybe some term, 3 years down the road, you're successful, that's when our customers get cherry-picked out of our portfolio. And I understand the complication that the guaranteed portion many banks sell in the secondary market. So then there's an issue with that. But if it is a portfolio loan, let us take the entire risk back in-house, and then that would be more dollars back into the SBA program to leverage into new small business.
Mr. Wilkerson, could you talk about credit elsewhere provision and how it helps the SBA 7A program?
Well, again, it's the cornerstone of our program, and we are optimistic that the new language provided in H.R. 4743 will clarify that for lenders so they know exactly what is expected and how the file will have to be documented in terms of how they determine that the borrower could not get credit elsewhere. So the old definition is quite old. It has not been updated for many decades and really doesn't fit the marketplace in which we lend today. So we're cautiously optimistic that this language will pass and it will make our jobs a lot easier.
Thank you, Mr. Chairman. I yield back the balance of my time.
Thank you very much. Gentleman yields back. The gentleman from Utah, Mr. Curtis, is recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member, for this opportunity for this critical conversation in this very important bill. I must admit, as I've listened to the testimony today, my heart has raced and my palms have grown sweaty because not too many years ago I was an owner of a small business. And the trauma of going through loans and navigating this, signing your home up as collateral, I think we frequently underestimate the sacrifice our small businesses make to drive our economy and to employ people. And as part of that experience, I like to think I know how a lot of these businesses think. And you won't be surprised that many of them find institutions difficult to navigate. They may be very good at patents, they may be very good at manufacturing, they may be very good at sales, but they're not necessarily very good at navigating. And Ms. McDonald, if I could start with you because of your title, and then ask the others as well to answer this question, and that is, are we doing enough to market and to help businesses that are not walking through your door, who need this vital program but don't understand? And if we're not doing enough, what should we be doing?
Well, my credit union career actually started in marketing, so I love the idea of marketing all the time, and we do a good job of marketing at Randolph Brooks. The concern that we have is that if we put up a billboard on 281 in San Antonio that talks about the business loans that we do, we would get inundated and we wouldn't be able to serve those members effectively. So we have to be very strategic in how we market the program, because the worst thing that can happen is you get 1,800 phone calls and you're not able to service them. But we work with our local SBDCs, we work with the SBA, we work with our members. And really that's where our program started, was not that we were going out and marketing small business loans. It was our members that came to us and said, hey, you do a great job with our personal stuff. We want you to take care of our business needs also. And so that's how we grew into business lending, was because the members were asking for it. So word of mouth does a really good job for us.
I don't know if any of you other want to weigh in on that. I think, but please, yeah, Mrs. Husick.
One of the things we do at Centric Bank is we work with SCORE. SCORE is the Service Corp of Retired Executives, or mentoring for small business. And we do, over the year, we may be doing 6 to 10 events where different seminars they may have. We're educating those who have an interest to own their small business to how to navigate the waters. What do they need to do to be prepared? There's other things we do. We reach out to our local economic developments, our chambers, throughout the areas in the markets that we serve, and being able to be a resource if there's questions, but also to have individuals they can come forward to being prepared if that's something they're looking to explore.
Thank you. I'd like to take this opportunity to point out to all of us that we have more work to do. The fact that we would flood your bank if it was advertised is it points out that there are just a lot of businesses out there who need access to this, who don't understand it, and hopefully we can do more for them. I think the last question that I'd like to ask, and maybe I'll start with you, Mr. Wilkinson, is if you're familiar with the fee enough that's associated with this, to comment on how prohibitive is that for these small businesses? Clearly, we're taking them above market rate by doing this. And are you finding that we're eliminating businesses and turning them to other less traditional sources because of that fee?
Okay, as with everything else in our program, there's not really a very simple answer, so bear with me. But there is a sliding scale of fees charged to the small businesses that increases as the loan size increases. And you know, given our loan volume, it's easy for me to say no, they're not prohibitive, because we're still seeing a strong increase in demand. On the interest rate side, we are legislatively capped at for most loans prime plus 2 3/4. So the interest rate today is, I forget what prime is. Where are we, 4? So we're like 6 3/4 on our interest rate cap. So the pricing is really not pricing folks out of the market.
Okay. Please.
Well, I agree. And the thing about the pricing, while a lot of customers, kind of flinch at the pricing, it does give them an alternative to credit card financing, which, I think the SBA does a great job in providing capital access rather than going through the credit card.
Or hard money loans.
Or hard money.
Yes. Mr. Chairman, I yield my time.
Thank you very much. Gentleman's time's expired. The gentlelady from California, Ms. Chu, is recognized for 5 minutes.
Thank you. Mr. Wilkinson, as you mentioned in your testimony, the authorization level for the 7A program is typically set 18 months in advance, and it's hard to anticipate the level of demand that far out. Before 2014, had the 7A program reached the cap before the end of the year? And what do you believe has changed with lending over the past few years to cause this increase?
Yes, we hit the cap a couple of times before 2014. I believe there was 2003 and 2004, if my memory serves me correctly. But today we have more lenders participating in the program than we did back then. So the program is much more robust and more dynamic. It's growing, and it's tough to really gauge what our growth rate is going to be 18 months in advance. And that's why this flexibility language is so important. We try to do a good job of surveying our members and get their estimate in their budgets, what is their growth forecast for the next year. But again, 18 months in advance is a long way to try to guess where we're going to end up and what things might be happening in the economy along the way that might stimulate or cause demand to slow down. So the flexibility language, in our opinion, is critical so we don't bump into those caps and cause program shutdowns going forward.
And then there's the issue of oversight. As the 7(a) portfolio has grown nearly 60% over the past 5 years, many questions were raised about how the Office of Credit Risk Management was handling oversight of such a large portfolio. So, Mr. Wilkinson, the Small Business 7(a) Lending Oversight Reform Act would require OCRM to prepare a budget justification for Congress in order to create more transparency. How will this requirement address some of those concerns?
Well, we want to make sure that the Office of Credit Risk Management has the tools and resources it needs to conduct appropriate oversight. I think that's the critical part of this program. As I mentioned before, we want to have a program of integrity. That means we keep everybody between the lines so that this program is here for the long haul. We as lenders would like to know what resources is OCRM getting. Part of those resources we're paying for, so we'd like to know what that might be. And then just to know that they do have the tools and the resources they need to get the job done. One of our issues with OCRM has been they'll come out and they'll do a review of a lender, and sometimes it takes several months before that review is completed. And hopefully with the additional resources, they can provide those reports in a more timely fashion, and it's much more beneficial to the lender if they are having issues that they find out about them today rather than a year and a half from now.
In fact, that leads to a question I have for Ms. Husick. In addition to requiring SBA employees to manage reviews, the Small Business 7(a) our Reform Act also sets timelines for review reports and correspondence to be transmitted back and forth between SBA and lenders. Can you tell us why it's important for SBA to provide lenders with an audit report within 60 business days instead of 18 months, as has happened in the past?
It's very important to receive the feedback. So, for example, that if an organization is, is perhaps in some things, if there's a common thread, something systemic in with the underwriting or something they're not doing, I think it's important to get that feedback, especially if you're a more robust lender or any lending at all, and important to be able to receive that feedback to make any modifications and corrections, what you're doing at your particular organization.
Now, it's my understanding that many of the SBA lenders rely on the services of third-party agents to assist in the origination, closing, servicing, and liquidation of these loans. You mentioned, Ms. Husick, the lack of training is a problem in the loan liquidation process. Could you please elaborate?
Yes. So for us at Centric Bank, we do utilize a third party to assist us with any, if there's liquidation, et cetera. During the course of Centric, we have not had that particular issue with us. We are at a 0% delinquency as well as a 0% default rate for any type of SBA lending that we have done. But we have heard it's been a common thread within the industry as well as to ensuring the particular order that you go in to liquidate is to ensuring that you maintain and preserve the guarantee piece.
Thank you. I yield back.
The gentlelady yields back. Thank you. The gentleman from Iowa, Mr. Blum, who's the chairman of Subcommittee on Agriculture, Energy, and Trade, is recognized for 5 minutes.
Thank you, Chairman Shabbat. Thank you to our panelists for being here today. Appreciate it very much. I'd like to focus the next couple minutes, if we could, on the default ratios of the SBA 7(a) loan program versus your commercial loan portfolio as a whole. Can you compare and contrast those, the three of you that work at financial institutions, please? Ms. Blankenship.
I would say our SBA default ratios are very low. It's probably 1% or less than our total default ratios.
What would your total commercial loan portfolio default ratio be?
Historically, well, our past dues are about 2%. So the default, our charge-offs are maybe 0.5. So we don't have a lot of charge-off and default ratios. And particularly on our SBA, we've had great historical, we don't have a zero such as Ms. Husick, but traditionally they've been very low. I think the program and its integrity, and I thank this committee for holding this oversight, because we want to preserve this program and make sure that there aren't third-party players, and you can preserve this program so that we can offer, these are good customers, they just needed extended terms.
I was chairman of the Directors Credit Committee on a $1.5 billion bank before this life, and we would ask the question occasionally, if our default ratios got too low, are we taking enough chances? Do you think you're taking enough chances?
Well, I
Is
think,
the collateral requirements different on an SBA loan than they are a general commercial loan?
sure.
Are they more
I mean,
stringent?
the collateral requirements on an SBA, you have more flexibility with collateral, and as well as terms. Terms are a big deal, so that you can stretch that repayment term out and allow that customer to have enough cash flow until he gets his business up and successful and running. And so that's one of the biggest advantages. The reason that we can't make a traditional or conventional credit under current regulatory guidelines in our banking environment.
Ms. Husick?
For our portfolio and our non-SBA, so our delinquencies and our non-accrual, we're at 0.42% of our lending portfolio, very pristine. And you're looking
Very
at
pristine.
At our asset
Congrats.
quality of our SBA loans, we have a 0% default rate and a 0% delinquency. We've been doing that, it'll be almost 11 years. And over the past 6 to 7 years, we've been a much more robust lender in those regards. And I have to say, if I look historically through the life of Centric, especially if you look over the economic downturn, you would see loans that had gone bad during that period of time. I think especially over the past 2 to 3 years, there has been a much improvement in the credit quality through financial institutions in general.
I mean, 0%, that's off the charts. You need to take more risk.
When you see our lending numbers, we're doing, really a robust amount. As I mentioned, last year we did over $41 million with 77 loans in the SBA, and total lending over $210 million that was improved. One of the things so important to us is setting the client up for success. And there's a lot of, as I mentioned, the numbers that we approved. There's a large list of the numbers, and I'd say equivalent to 25 to 30% that we've said no to. One of the things we do like to do is, if we do say no, we give them a way and a path. How do you get to a yes? And so almost some homework maybe to go back and to say, these are some of the things, if you work on and improve, we could perhaps help you and assist you in the future. But until some of these things have been worked upon or done or enhanced, we want to set them up for success and that make it a win-win.
Ms. McDonald?
Well, just like Ms. Blankenship and Ms. Husick, we have a very low delinquency ratio, charge-off ratio. Again, not at 0%. We do take a little bit more risk, but it depends on what the needs of the member are. And that's, for us, it's what can we do to help the member? How can we help them either grow their business or start a new business?
Is it higher or lower than your commercial loan portfolio? In general?
It's generally just a bit higher, but our commercial loan portfolio is incredibly low as well. I want to say somewhere between 1% and 1.5%.
Would your lender banks, what would the experience be there in credit unions?
Expecting that you were going to ask this question, I brought the numbers. So there's two different ways to look at this. The way you as a banker would look at it, what was the charge-offs this year, and what was our loan portfolio balance at the end of the year? So for at the end of fiscal year 17, that charge-off rate was 0.8 for the entire 7A program. Now, the other way that Office of Management Budget looks at this is, rather than, as a typical banker would make a loan to a business and have that loan renew every year, so a 15-year loan would be 15 separate loans for the bank. SBA looks at this as one long 15-year loan. So they look at it as a cohort. They call it a cohort of loans. And how does that cohort of loans perform? And they've then come back with all those numbers from all the cohorts that they have, and they put that in the budget request. So in the fiscal year 18 budget request, our defaults net of recoveries over a portfolio that can span 25 years was 4.49. So you figure an average life of about 10 years, our annual charge-off rate would be somewhere just under 0.5.
The gentleman's time has expired.
That's amazing, and I yield back.
Thank you. The gentleman from Florida, Mr. Lawson, is a ranking member of the Subcommittee on Health and Technology, is recognized for 5 minutes.
Thank you, Mr. Chairman, and welcome to the committee. One of the things I read in the proposed legislation, and maybe you can respond to it, is that the lending to smaller firms over 2008 to 2016 went down by about 13.7%. But the increase to larger firms went up by about almost 46%. What happens in that regard?
So you're talking about loan volume?
Right.
Okay, so I'm going to look at loans of 150,000 or less. Back in 2015, our numbers dropped, but our dollars moved up. So we were making fewer number, but larger dollar amounts. And then going up to the next step, 150 to 350, those numbers actually improved slightly.
Okay. Did anyone else want to comment on it?
I mean, what I can tell you is that that's not an issue at Randolph Brooks. More than half of our SBA loans are less than $75,000. So that's kind of our niche.
Okay.
The other thing I would add is if you look at the current fiscal year, the loans in the small categories are all up. So while through fiscal year 17 they were, flat or modest, they have begun to move up in the current fiscal year.
Okay. And Mr. Wilkinson, since you're talking, can you discuss the effectiveness of the oversight mechanism that SBA had put into place, including risk profiles to guarantee that the 7(a) program is effective?
Yes, they developed they call it Paris, a risk protocol where they review lenders. It's a very robust system. It's still relatively new, but it looks like a really good system. We'd like for them to have a few more years, managing this to see how it works out. But we think it's a pretty good oversight tool.
Right. And one of the things that was very intriguing is, I guess in the credit union, they must be doing something very significant because when you say that you don't have hardly any defaults, what are you doing during the course of the loans to put you in that position?
Well, we work with our members. It's about communication. We look at our loans depending on the amount of the loan. We look at either a quarterly or a semi-annual basis. We go and we talk to members. We see how things are going. We make sure that line of communication is open. We have a very good underwriting staff, and we do a very good job with our loans.
Okay, well, thank you. And Ms. McDonough, can you discuss the growth in the 7(a) lending? I believe that the data shows that growth in lending has increased. So what does it do for the small dollar loan? And you can tell me a little bit, what do you consider as a small dollar loan?
Well, for us, a small dollar loan is, well, by SBA standards, less than $350,000. For us, it's really anything less than $100,000. And again, that's mostly what our niche is. And your question was, how are we increasing it?
Right.
We have tremendous member loyalty. And so when you do something for a member at a $75,000 level that maybe they weren't able to get somewhere else, or maybe somebody didn't spend the time with them and you're able to help them, then they tell their family and they tell their friends. And that's the best kind of advertising that you can have, is that word of mouth. Randolph Brooks has been very successful in helping people with their personal finances for a very long time. And as I mentioned before, the only reason that we got into member business lending is because those same members were coming to us saying, we want you to help us with our business needs.
Okay, and real quick, and anyone can respond to it. It was always some consideration that the commercial banks area felt that credit union was doing more than they're supposed to and getting involved in business lending. Is that generally the same feeling? Yeah, yeah, Mr.
We see quite a bit of that in our market area. We see, in fact, the credit unions are reaching out to do more commercial loans on their various electronic signs out in front of their numerous buildings. They do. They have signs. We do commercial loans, and there is a big push towards it. You know, our goal is, yes, we want to help the small business in our community. Just the pieces, we'd like to be able to have a level playing field in order to compete.
Mr. Chairman, with that, my time run out. I yield back. I have a lot more questions I could ask.
All right, thank you very much. The gentleman's time has expired. And the gentleman from Kentucky, Mr. Comer, is recognized for 5 minutes.
Thank you, Mr. Chairman. And my questions are going to be geared towards Ms., is it Husick? Am I pronouncing that right? Well, I appreciate the American Bankers Association, like Congressman Marshall and Congressman Blum. I served as a director of a bank, 15 years, community bank, back in Kentucky. And we didn't do very many SBA loans. I know other banks did, but we, for whatever reason, did not do that many. But I'm curious, when a small business customer enters your bank, how does the conversation proceed all the way to an SBA loan? Is there a reason you send it to the SBA, or what's the process to get that customer towards an SBA loan?
Sure. So at Centric Bank, we have a total of 15 commercial lenders. We do not have any individuals that are solely focusing on SBA loans. I'd say out of those 15, about half of them are contributing to the bulk of our SBA loans. And again, they're doing other loans that are non-SBA as well. So, and times, and just recently, I sat down with a client, and many times a prospective client. So part of the conversation when someone say they're looking to, say, maybe start up a new business or acquire a business, you know, we go through the process to ask them, you know, do you have a business plan? From there, you know, looking at the specifics, you know, with the financials, the tax returns of them personally, personal financial statement, a business plan for the business. Perhaps they're acquiring the financials to support that and their projections. First and foremost, we're always looking at, can we do this loan conventionally? That's where we start. When there are times that we are unable to get them there, we're looking at perhaps they don't have the required amount of down payment. Is it 20 or 25% in to purchase of the own skin in the game of their own funds and needing a lesser down payment? Is it a collateral shortfall, as when they're purchasing a business, there might be a more significant dollar that's associated with goodwill? We're not going to do an extended payment terms of, you know, past a 7 or 10 year if we're doing that conventionally. So first and foremost, we walk through those questions. Can we do it conventionally? When we cannot accomplish that, you know, we like to look at how do we get the client to a yes. So the SBA program would be the next one we're looking at. And at times we're looking at the SBA 504, so it isn't necessarily always the 7A. We're looking at what makes the most sense for that particular customer in front of us. At the end, we want to be able to set them up for success through that process. And at times I look at it, we're a consultative banker to them and trying to help navigate through the process and maybe some things they don't have sufficient information coming to the table.
I'm going to switch gears here. Dodd-Frank, that's something I hope that we can somehow repeal. I know the House has passed legislation to repeal it. Maybe a compromise, since we can't seem to get there in the Senate, would be just to focus on community banks, try to ease up the regulatory burden that community banks face with, in my opinion, the excessive regulations and the excessive compliance that's required now because of Dodd-Frank. My question with respect to this testimony, has Dodd-Frank had any effect on the 7A loan program? Are more customers having to qualify now for an SBA loan because of Dodd-Frank, or less, or has it affected the availability and the access to credit any with the SBA program?
Well, I look at, there's an aspect of Dodd-Frank that has not even come into place to, as far as being effective for banks to needing to do, and that is with small business lending, where the data needs to be compiled and will need to be compiled going forward if something isn't done or impacted, we're to compile that, similar to a HMDA for the residential loan. So that is particularly, that's outstanding. You know, in general, Dodd-Frank, additional of hiring individuals for the compliance rules to be able to oversee, and so that, you know, that's cost us as community banks to having that. You know, you get into qualifying mortgages, you can get into a lot of non-commercial as well, but the regulatory burden has been significant and onerous on community banks.
Okay. Thank you, Mr. Chairman. I yield back.
Thank you. The gentleman yields back. The gentlelady from Puerto Rico, Jennifer Gonzalez Colon, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for all our witness today. My first question will be to Ms. McDonald, and it will be, as part of your testimony, you highlight the importance of better definitions for penalties in page 15. What kind of errors should be defined as minor compliance errors, and why?
Thank you. The minor compliance errors would be if somebody put the wrong date on something, if somebody, you know, check the box wrong. What we would like to see is there be a difference between willful, malicious negligence in trying to do something on there, and another would be it's a training issue and we screwed it up and we need to understand what the penalties are, because between 0 and 250,000, that's a big number.
And what penalty should be applied to those errors?
Oh gosh, that's... In most cases, I would say if it's something like where you changed a date or you messed up in that, it'd be better to point it out first and then have some type of a penalty after that.
Okay. My second question will be to Mr. Wilkinson, and it will be, you mentioned the Paris system on page 10 of your testimony, highlighting that it is in the infantile stage. Do you think the system can converge with the new regulations or be adapted?
To the new the proposed legislation?
Yes.
Oh, yes, I think it can. That should not be an issue at all.
So without a problem, and we,
Not in my opinion.
okay,
SBA may have a difference of opinion, but it should work just fine.
okay. And my last question will be to Ms. Blankenship. In your testimony, you mentioned that credit elsewhere test. Please explain how the test operates and the average time it takes to do that, and what other documentation is required in addition to the inability to receive other documentation that is required in addition, to have the conventional credit.
Well, I think the credit elsewhere test, we're encouraged by, as Mr. Wilkinson said earlier, it was fairly ambiguous before. And the last thing that we want to do is be out of compliance with the expectations of the program. So by defining the credit elsewhere test criteria and making it as simple as possible, although remember, every applicant is a custom deal, more or less. And typically, a lot of times we would use what our regulators would allow as a conventional loan, and if we couldn't get, that done, and you can look at their credit scores or their lack of collateral. So it's fairly easy to know that this wouldn't be a slam dunk credit approval process. Again, I just applaud this committee for trying to preserve this SBA program. We have used SBA program since we opened our bank in 1986, and it is a cornerstone of our lending. And thank you.
And
we appreciate that.
And we do support that. What other persons or people are involved in this process beside the bank and the client?
At Bank of the West, since we've had this program since 1986, we have a very dedicated and trained, this is a niche program, and it is complicated, so we actually have about 6 people on staff that specialize in SBA. So they work in conjunction with the lender, and so we have our credit analyst and our loan department and our underwriters that also assist that loan officer.
Yeah, but beside the client and the bank, to the credit elsewhere test, it's anyone else besides the client and the bank?
Where would
Well, outside the bank and the client that is working on that, or no?
typically it would just be the client coming to the bank for us, and then we would determine if it meets the criteria of the credit elsewhere test.
Thank you for being here, and with that, Ms. Chairwoman, yield back the balance of my time.
Thank you very much. Talofa, and good morning. You know, I'm really looking forward to being back home in sunny and warm American Samoa, out of the snow. And I want to thank the chairman and ranking member for holding this hearing. Okay, so I've got a question for all of you. From your perspective, does the length and the cumbersome nature of the SBA application process hurt a small business's ability to access capital? Ms. Blankenship?
Yeah. Well, it is a cumbersome and lengthy process, and you know, I would be lying if I told you that our customers are often disgruntled with the amount of paperwork. But I think when we show them that it's such a viable alternative for them, and they couldn't get this credit elsewhere, and in our case, since we've been doing this for over 3 decades, we've sort of perfected holding their hand and counseling them and walking them through the process. We'd like to see it streamlined. We like to see more specific definitions, but it works for us.
Ms. Husick?
To echo the same points, it is a more complex process, and I have to say, of all of our small business clients that come into Centric, and I would say less than 5% walk in the door and say, I want an SBA loan. And in fact, when that topic ends up getting brought up for a discussion point that they did not qualify for conventional lending, you have probably about half of them saying, I don't want to do a government guaranteed loan. And because they said, I've heard through, other individuals that it's a very complex process, it's a very time consuming. And, for us, we are not a preferred lender. I'd say an average turnaround from application to the time we close could be 6 to 7 weeks. We have had those that have in excess of 3 months. So I think some of those things could be perceived by that small business client as, again, cumbersome, again, to the point of, that at the end, if that is the way that they are going to be able to realize their dream of owning their own business, we can get them to a yes by that, and to show them, we're there working with them as a partner to accomplish that.
Ms. McDonald?
Just like they said, there is a perception that SBA loans are very onerous, that they take a lot of time. We are a preferred lenders, but there are a few times that we do have to send it through general processing, and that can take up to 8 weeks. So that is somewhat frustrating, particularly for our members. But as I think Ms. Blankenship said, the benefits to the member is what helps us sell the program.
Mr. Wilkinson?
Last year, we did over 62,000 loans. We're on pace to do over 65,000 loans this year. So there are a lot of small businesses that do not find this too cumbersome. I think especially when they figure out that they're able to appropriately finance a long-term asset with a long-term loan that reduces their monthly payments and puts their business in a proper spot, the paperwork suddenly gets forgotten.
Thank you. I reserve my time.
Thank you very much, Madam Chairman. And we want to thank everyone for coming. If people were wondering what happened, we had a markup in Judiciary. Most members, in fact, all of us are on several committees, and the Judiciary was marking up a bill, and they needed my vote for it to pass, and it did. So, but I think all the members who had any questions got to ask them. We want to thank the very distinguished panel for their excellent testimony this morning and now into this afternoon. I think you all did a very good job. It helped us to learn more about this program and how it impacts out there, especially among small businesses, which after all is the focus of this committee, and also the legislation that we're considering as well, which is both bipartisan and bicameral since the Senate is considering as well. So we want to thank you very much all for shedding light on that, and I would ask unanimous consent that members have 5 legislative days to submit statements and supporting materials for the record. Without objection, so ordered. And if there is no further business to come before the committee, we are adjourned. Thank you very much.